I would like, yep, I should have told them, reporting perfect. And I would like approval of the minutes from June 9th. If anybody's read them over, which I have, and I didn't see any real alterations.
One minor correction, Frank. There's a typo. Let me find it. It's in the first part where we're mentioning rebalancing. The word asset is missing a T. I gotta find it now, but do a spell check on it, you'll find it. Asset is spelled A-S-S-E.
I didn't catch it because I'm not a good speller. Aside from that, if there's no other changes.
Move we adopt.
Second, all in favor?
Aye.
Right.
Opposed? Passes unanimous. Are there any public comments? Anybody from the public would like to speak?
We do not have anyone from the public attending.
Excellent, thank you very much. The next is approval of the pension applications. Hello,
I'm here. Jerry's
Jerry?
here. Can everybody hear me? Can
Yes.
everybody hear me?
Yep.
Okay, we have 5 pension applications that were submitted during the summer months, and I will present them to you now. The first one is Catherine McLean, a nurse with the Board of Education, age 65. She's a regular pension. She elected option 1. Her monthly benefit is $3,222.12, annualized to $38,665.44. Second one was Erin Herring, administrative support with Recreation and Parks, age 61. Hers is an early retirement. She elected option 3. Her monthly benefit is $1,017.70, annualized to $12,212.40. The third one is Kathy Lanzaro, special ed aide with the Board of Education, age 65. Hers is a regular pension. She also elected option 3. Her monthly pension is $425.72, annualized to $5,108.64. The fourth one is Frances Iacono, special ed aide also with the Board of Education, age 69. Hers is a regular pension. She elected the standard form of benefit. Her monthly pension is $1,553.36, annualized to $18,640.32. And the last one was Stuart Muchnick. He is a grants/compliance finance specialist with the Board of Education, age 62. His is a regular pension. He elected the standard form of payment. His monthly benefit is $2,569.28, annualized to $30,831.36.
does anybody have any questions regarding these pensions?
No.
I do have one question on Mr. Munchnick. One of the things is that the designated beneficiary is 97 years old, and then the contingency is 90 also roughly. Is there a way?
Yes,
that,
I actually had a conversation with him, Frank, about that. He has no children, no siblings. He did acknowledge the fact that his parents are up there in years. Unfortunately, those were, I guess you would call the de facto beneficiary, since he doesn't have any other next of kin with whom he could designate as a beneficiary.
If say that his father passes away, is there a way that you then add a different, contingency beneficiary? It could be a church, it could be a charity, it could be a nephew, or just,
It's gotta be a person, Frank.
Yeah,
I don't know. I don't think it
I'm not sure
does.
it's a good idea for the pension board to get into the habit of recommending
I
beneficiaries.
just, right, well, I'm just asking because it does seem that, I've just asked if, I thought we have in the past, somebody did leave it to not an individual. But at any rate, that was my question. I'm glad you discussed it with them, Jerry. Is there any other discussion? If not, is there a motion to accept the approval of the pensions?
And move we approve the 5 pensions as presented.
Okay, there's a motion. Charlie has accept the pensions. Is there a second to that motion?
I'll second.
Thank you. Any discussion? If not, all in favor? Aye.
Aye.
Opposed? No, passes. Perfect. Thank you. Next is Pantheon. We have Jeffrey Wright.
Great. Thanks, Frank. Good to see everyone. So we have Jeff Wright here from Pantheon to do a portfolio review. If you recall, Norwalk is invested in 6 different Pantheon funds. Most of them are pretty old and in the process of winding down. I think the US Select 2014 fund still has about 18.5 million in commitments and called capital and market value, and they're still occasionally calling capital there. So Jeff will provide an overview of Norwalk investments. And Jeff, if you want to mainly concentrate on the wind down process of the older vintage funds and the status of the US Select 2014 fund and outlook there, that would be great.
That's terrific. Britton, thank you for the introduction there. Nice to meet everybody. I'm Jeff Wright. As Britt mentioned, I'm a principal on the U.S. Investor Relations team here at Pantheon. I've been here for approximately 3 years, but in the industry for almost 2 decades. And look forward to taking you guys through a brief organization and team update, and then digging in on kind of the winding up process with some of your long-lived vintage year funds, and digging in on what we're seeing within US Select, your most recent allocation in 2014. And along the way, feel free to ask questions. I want to make this as fluid and advantageous to your process as possible. So maybe with that, I'll give you a brief. Does everyone have the presentation in front of them?
Yep, we do.
Terrific.
Yes.
Thank you. Brief overview of what's been going on at Pantheon. So as it stands now, we're almost 4 decades in the business, exclusively focused on private markets. Over the evolution of the firm, we started out as a traditional fund of funds manager, as you're probably aware, and as our clients have evolved, so have we. We've also expanded across the private markets, asset classes and strategies. So over time, not only building out our primary capabilities, but our secondaries capabilities, private equity co-investment, and then our most recent legs to the stool, if you will, were the introduction of our infrastructure team in mid-2000s. And that's a primarily secondary and co-investment focused strategy. It's global in nature, as most of our funds are. Private debt, which we signed on as a dedicated strategy in 2019. And then you may have seen in the trade magazines or so forth, in June of this year, we brought a team in from GI Partners, which is a private equity real estate and infrastructure firm based in San Francisco, to lead our real estate solutions practice. And we're super excited to have those folks join the team, and they'll be based in New York. As it stands now, Pantheon is about 380 folks globally across 10 offices. We are a global organization, and so we feel it's necessary to have folks in all of the relevant geographies that we're allocating capital to and reviewing managers in. Of that 380, about 113 of those folks are investment professionals. They are dedicated to their strategies. So we have a primaries team, we have a secondaries team, co-investment, et cetera. And we think that's really important, to be in the minutia, if you will, of those businesses, but it also encourages collaboration across the organization, given how we source and execute on these transactions. As it stands now, we're about 71 billion in assets under management. About 40% of that is in commingled funds, where yourselves are committed. And then about 60% of that is in more bespoke or customized vehicles, where we have some larger investors, but certainly some smaller ones as well, that want or have taken a view on where they want to allocate capital, be that by strategy or be that by geography. And they use us as a manager or a conduit to allocate to those places. Over 690 institutional investors globally, very diversified kind of across those institutional investors. So public plans like yourself, not only at the city and county level, but also at the state, healthcare organizations, insurance companies, endowments and foundations, et cetera. And we sit on about 485 advisory board seats. That's important, I think, and you'll see as we talk through this wind down process, but those advisory boards, we're sort of the first ear in terms of hearing what's going on within those portfolios. It helps our co-investment and secondary teams source and diligence transactions. We feel it gives us a competitive advantage in the marketplace, and have invested in over 2,000 funds since inception. Lastly, I'll leave you with, and you're probably familiar, we were one of the, I think we were number 36, I believe, out of over 2,000 now signatories in the UNPRI. The firm are big believers in responsible investing and ESG, and we put that into practice not only internally when we're diligencing our managers, but also pushing externally on our general partners to make sure that they have best practices, be that with how they're running their businesses, their underlying portfolio companies, but also how they're reporting on those business lines. As an organization, ownership and leadership remains between us and AMG. This is now going on a 12-year relationship with Affiliated Managers Group up in Pilgrims Crossing, Massachusetts, a little north of Boston. It has certainly yielded us lots of advantages. We've been able to keep our independence. We have really no input from the AMG side. They allow us to run our business, but it offers us strategic support, and we continue to own approximately 33-34% of the business moving forward here. The last thing I'll leave you with in terms of organizational updates is on slide 6. It's our available and upcoming strategies. As I mentioned, we have primary, secondaries, co-investment capabilities, but also within strategies, infrastructure, real assets, private debt, and our bespoke or custom solutions. All of the strategies or funds you see on this page are open and accepting capital at this point. Some of them are recent fundraising announcements. Others have been in the market for a few months to a year, and will be wrapping up their fundraising shortly. Maybe with that, I'll pause before we get into a portfolio review, if there's any questions on the team or the organization. Otherwise, I can sort of jump into the summary of Norwalk's commitments.
Let's get with it.
Sounds good to me. So slide 8, and I think we can focus on, this is just a snapshot, a summary level snapshot of your performance. You'll see a hair over 60 million committed to us since 2000. We have effectively distributed with NAV of approximately 1.6. That's a net multiple. And while the IRR has dragged a bit at 8.7, I think you'll see some of the more recent performance. We've certainly seen an uptick, and the 2000, the 04, and the 06 vintage years, frankly, suffered a little bit from the coming out of not only the dot-com bubble in the 2000s, but also the great financial crisis that I think impacted a lot of portfolios during that time. But we continue to work through active management, our investment teams do, to make sure we're squeezing all the juice out of the lemon, as you will. And I'll save the wind-up commentary for a little bit later, but I did want to take you through some of the performance metrics. I think most relevant is slide 10. It's the progress we've made over the last year.
Hey, Jeff,
yeah.
I got a real quick question.
Sure.
Using simple math, I'm just curious, maybe
Yeah.
I'm not seeing it the same way. If I look at the one that came out in 2000, we
Yes.
put in 14.7, we got back 23.4.
Correct.
So I look at that, simple-minded, I do the math, and it works out to like, 8 million, something like that, which is about a 59% return. Divided by 20 years, simple math, 2.95% a year. Am I missing something? When you say internal rate of returns 10.2, my simple math comes out to 2.95.
Yeah, Joe. I mean, I think that's one way to look at it. There's time weighted returns and there's also dollar weighted returns. IRR is a dollar weighted return, so it's dollars in, dollars out. Another relevant way to look at this would be on a PME basis, so a public markets equivalent. And we'd be happy to run that analysis for you. But effectively, what the public markets equivalent does is say, every time you make every time a capital call is issued or a distribution notice goes out, we either put capital into the market or pull capital out of the market. And what would that look like over the course of that 20 years? And so IRR, how you would look at it from kind of a total return within the public markets is slightly different from IRR, which is more dollar weighted.
Okay.
And Jeff, can you touch on, it's been 20 years since this fund was started, and obviously some of the volatility post.com has certainly delayed the complete exit. What's the, estimated time frame on Norwalk to get their money back / these funds to really wind down truly?
Absolutely, Britt. And maybe I'll cover your Pgsf 4 investment, your Pgsf 6, your Puro 5A, and the Pgsf 3B investments. So kind of the 2000 to 2006 timeframe, save for Pgsf Fund 7. So with taking Pgsf 4 first, Britt, we have actually initiated a sell in the market. We hired Lazard. We launched what we call Project Lake. It went to market in early July of this year. It includes your Pgsf 4, Pgsf 6, Puro 5, and Pgsf 3 commitments. From there, we reached out to 33 potential buyers. 16 parties conducted due diligence on the entire portfolio that we put out. And on July 27th of this year, we received 6 indications of interest of varying sizes. We took 2 of those groups through to the second round and received final bids from both on the 1st of September, so a week ago. And the most compelling of which was an 82% of NAV or an 18% discount to where NAV hits now. And I'll say from a pricing perspective, our initial expectations for pricing for this portfolio was anywhere between 70 and 80%, given the tail end nature of the portfolio and the mix of quality in there. So with the final 2 bids coming in at 82%, pricing certainly came in better than our expectations. I think most importantly for you, this pricing has very minimal impact on the ultimate IRR of the funds, given the maturity profile of those funds, or those positions, and the limited size of the sale portfolio. So when I look at Fund 4, we're in our ninth extension there. There's one remaining active fund in the portfolio, Oak Investment Partners 10. This fund has currently one outstanding portfolio company investment, and we're seeking liquidity options there. The GP, Oak Investment Partners in this case, stated they aim to resolve the outstanding matter with that underlying portfolio company before the end of this year. So we expect that to be fully dissolved, save for a holdback for any indemnities that may occur by the end of this year. With PUSA 6, your 2004 vintage, we are selling 12 of the 20 remaining funds in there. Fund 6 is in its 5th extension right now. And they're part of Project Lake, which is a process that's going to be, as I mentioned, completed at the end of this year, potentially drifting into 2022. But really, for tax purposes, we're trying to push towards the end of this year. With Puro 5A, we're selling 14 of the 42 remaining funds. Fund 5A is in its 3rd extension right now. We still think there's a significant amount of value left in this fund, which we believe can be extracted over the next 24 months through normal course of business. There's also significant public exposure, which will result in substantial proceeds in the next 6 to 18 months at expected uplifts to carrying value here. And then finally, yeah, go ahead.
I was just going to say, but with an 18, if the end of period market value on these different funds and roughly an 18% haircut, am I correct to say that we're talking about a hit of about $500,000?
I wouldn't look at it that way. What we endeavor to do, Frank, in this process is say, of the remaining funds and underlying portfolio companies within your particular commitment, where do we think we can extract value, and where do we think that the GP isn't going to be able to drive enough value to make it worth your while from an administrative perspective, and all the back office expenses that come with that. And so at an 18% discount, yes, the NAV will take a small hit on that, but from an IRR perspective, it is a very minimal impact. I'm talking anywhere between 0.1 to 0.3% of IRR.
Jeff, one other question. So you mentioned on PUSA 4 that there might be some lingering, potential indemnities that would have to be covered. What types of things are you generally indemnifying for, and what kind of exposure is there? And is that sort of across all these portfolios that there's
it's customary? Yeah, I'm sorry to interrupt you there, James. Yeah, it's customary across all these across any kind of secondary sale. There is our ability on this is primarily impacted by some intellectual property claims against Solar Flare, which is a company that Oak owns in that portfolio. It's the remaining company. And so there's some progress made on these claims against the escrow, but we have to hold back some of the capital for potentially paying some of that out. But in all likelihood, that gets resolved through the GP, and we have every indication that it will. And so it effectively works like holding carry back in the fund until the end of the fund to make sure that you don't have to pay your limited partners back if you don't hit that bogey at the end of the day.
So you hold that back if there's something there.
We will hold it back in all cases just to make sure that nothing comes up. You can't, as you know, it's hard to predict the future. And so in every one of those cases, there'll be a small holdback in capital to cover indemnities and so forth.
But you're holding back what you estimate the most likely scenario to be, not the worst case. I mean, how do you do that?
It's what we think the most likely scenario is based on our conversations with the general partner or general partners.
Yeah, thanks.
And then lastly, Pgsf 3B. We are selling all positions in this fund. It's in its third extension right now. The remaining assets of the fund aren't going to be wound up imminently, but are included in the current fund sale process. And again, this would likely be something that would be the sale that would be completed at the end of 2021, start of 2022. With PUSA 7, which is not included in our sales process, it's in its third extension right now. The fund is not included, as I mentioned. However, it's likely we're going to start looking at liquidity options for this portfolio in our next round of sale processes, which will likely be 2023. Every fund in this portfolio is still active, and the investment period was a little bit delayed. So the underlying investments are still in their investment period. PUSA 7 continues to have solid distributions, and the underlying funds are starting to look at continuation funds. So we're considering options as they become available.
Excuse me, I just want to back up for a second.
Sure.
PUSA 4,
Yes.
6, the 5A and the PGSF 4. So we're talking, we can expect to get a disbursement of our funds sometimes in the first half of 2022. Is that
Yes,
right?
Sir. Yes, sir.
And right now it looks like if we take we have 1.5, 1.7 million, and with the type of haircut we're talking about, we're looking at somewhere between 1 million and 1.3 million coming in. Is that fair?
Probably closer, a little higher than that probably, but I can get you the exact numbers, Richard.
I mean, so a little higher, are we talking 1.4, 1.5? I mean, I'm not,
Yeah.
I'm just trying to.
1.415, yes, sir.
Okay. And so now we're with PUSA 7, we have 1.5 there. Well, let's see, we have 5. Let's see, how much do we have left in there?
So PUSA 7 is at a 1.5 in NAV. That's not
Okay,
included. That's not included in the sales process.
And that's not including the sale process.
Correct.
And then we have Pantheon, which is 19.1.
Yes, sir.
Okay. And so, so you're going to spend most of your time talking about Pantheon, seeing that's where our most of our money's involved from,
yes, sir.
From going out here. Okay. Okay. I'm good.
Okay. Yeah, Rich, just as some context, a lot of these funds that Jeff is speaking about have really been in wind down mode for a while, and it's getting to the point where they're almost past their extension terms, and the value has been created that was going to be created. And at this point, it's really an administrative pain, to say the least. I mean, if you look at some of Norwalk's allocations, 0.04% of the plan is in USA Fund 4, but we have to continue to monitor it and report on it. Even though the reality is whatever happens to that NAV is not really going to affect the performance of the fund or the bottom line. So it's at this point, it's the select 2014 and what's left in the USA 7 that's really going to drive future performance and capital commitments.
Right. And I think I understand that. And that's why I wanted to make sure we spent most of the time focusing on Pantheon 14, where most of our exposure is.
Agreed.
Okay.
And happy to do that. And maybe with that, so USA Select 14, Pantheon 14 made its first investment in December of 2014. So, which amounts to about 4% of total commitments. And I bring that up because while it's considered a 2014 vintage, it really started going in 2015, 2016, and 2017. But so first investment was made in December of 2014. We overcommitted the fund at 108%. Those managers have drawn about 80% of committed capital. Much of the more recent vintage funds are still squarely within their investment period, and we'd expect we'd steadily continue to call capital over the next couple of years, given the young age of the portfolio. But if you look at over the last 12 months, we've seen really strong uptick in performance. So for example, net IRR has increased from 10.3% at March 31, 20 to 18.1% at 3/31/21. In addition, some of our preliminary figures indicates another significant valuation increase for the second quarter of this year of about 12.9%. And so from 2Q20 to 2Q21, the portfolio has seen about a 58% increase in value. And particularly in this environment, that's something or what has I think consumed us for most of that time period. We're quite pleased in how performance has gone there.
How much of a haircut did you take in COVID? Because if you're comparing to the second quarter of 2020, that's like comparing it to the bottom. So I mean,
sure.
What do we do from the second quarter of 2019, then 2020, and then to now?
I can go back and look at it and get Britt an answer to that to share with folks here from 2019.
Sure, that'd be great.
Okay.
And Rich, we do have this in our full performance reports in the back. I can show you after the presentation where we show the values, the capital that's been called, fees, basically all of the metrics of each quarter throughout for each fund.
Yeah, that's fine. The reports are lagged so much that I sometimes don't go back and look at it. So thanks for that.
And Richard, what I would say is you asked kind of, what has not performed to expectation or kind of underperformed over this time period. I don't think it'll come as much as a surprise as some of the energy funds. So Yorktown, which is an investment in USA Select 14, is held below cost, but most are on or above plan. With the exception of Yorktown, Shamrock 5, Industrial IOP 3, and Onyx 4. So Shamrock 5, this is a fund we think is ultimately going to be a good performer, but it was hit harder in COVID than some of the others. IOP, which focuses on industrial businesses, has faced both China trade restrictions and then COVID. So this portfolio has a lot of momentum, and the GP is anticipating exits prior to year end, but we don't have any specific information to this point. And then lastly, with Onyx 5, it's been moved to a watch list given its poor performance, but they've restructured their team in response to that volatile performance, and we continue to monitor that and sort of shepherd that team through where we can be helpful. So going back to kind of what's driving performance here. So much of the performance is driven by our managers. I think not surprisingly within the technology space. Frankly, we've seen IT and healthcare related services be the largest driver kind of across the board over the last 12 to 24 months. And technology has fared very well in the pandemic. The venture and growth equity managers are leading the way within this portfolio with respect to performance, generating 1.2x of cost and 1.5, or 2.1 and 2.5x So venture at 2.1, growth equity at 2.5. In addition, of the top 5 of the highest performing managers in your portfolio are growth equity and VC funds. For example, Veritas 5 is the highest performer by IRR contribution. It's a buyout fund, but it's fairly significant exposure to technology, albeit oriented to the government end of the market. If there's one sub strategy that has underperformed, and we put energy in this strategy, it's our special situations, but that's largely due to the exposure of energy funds. Lastly, I'll leave you with kind of our outlook or view on kind of some near-term exits related to this portfolio. There's nothing concrete that's there right now, but the exit markets have been very strong, and typically, we've seen exits have been at an uplift to where valuations are being carried now, and that's across the board and across asset classes. So we would expect the very same here. And some of our GPs, many of our GPs have been telling us that exits there are exits to come by year end, given some looming potential for tax changes at the federal level. So with that, I think that covers the portfolio. I'm happy to take any questions or take a deeper dive into any one of those funds, but certainly welcome the questions and certainly appreciate the time.
Just a general question. What are you seeing in terms of the industry right now? Is there more capital flowing into this space, driving prices up, or what are you seeing?
Yeah, look, there's no ifs, ands, or buts about it, James. I think valuations are being driven up. I think we're trying to find embedded value in some of the portfolio companies we're buying, be that on the co-investment or secondary side. We're also taking, an additional layer of scrubbing, if you will, on our general partner relationships as it relates to some of the primary funds we're committing to, and making sure that they're sticking to their knitting, that there's no strategy drift or shift, and they're being incented the right way to construct their portfolios. But certainly valuations have risen. There's a lot of institutional capital and frankly high net worth or retail capital that are also coming into the space, and so it's taking a guarded approach, but one that's constructive to kind of what we're doing. It's what you don't want to be is sort of out of the market as it relates to any one vintage year. You want to try to have exposure kind of across the board there, and there's varying ways to do that, whether it be through traditional primary fund of funds, secondaries, or co-investments. But we can't time the market, and I would have probably given you a very similar response, frankly, 10 years ago that I'm giving you now. So we continue to kind of monitor those portfolios. We think we team up and we build relationships with the highest quality GPs out there that are going to be able to weather, multiple market and economic cycles.
Okay, thanks.
Yeah, no problem.
I have 2 questions. One is, what is the percentage, when you're speaking about energy, what is the percentage of energy holdings in the 14 fund?
Yeah, I will grab that. So I will have to go. I'll have to get you that. I don't have that handy, Frank. I'll have to come back to you with that exposure. Oh, yeah, I'll have to come back to you with that exposure. I thought I had it.
Okay. And the only other thing is, how much money do you have in fund of funds?
In terms of capital, we've
Right. In say the 14, how much do you have in fund of funds?
that varies every year. So I don't have it off the top of my head what we've raised for Pantheon Select 14. But again, that's something I can get to you, and I know that's in your reports as well. Hold on, I may have it here. Yeah, I'm sorry, I don't have that with me either.
Well, if you could just send that along with the questions that Rich had for you, that'd be perfect.
Sure.
All right,
Absolutely.
thank you. Does anyone else have anything that they would like to ask? Or Jeffrey, is there anything else you'd like to tell us? And if not, I want to thank you for the presentation.
The only thing I'd say is I echo that. Thank you for giving me the time, and we certainly appreciate the partnership and relationship we have with you and with Callan. So thank you.
Thank you.
Thank you.
Thank you.
Take care,
you.
guys.
Thanks, Jeff.
I know. We will go now to Britt for performance review.
Thanks, Frank. And maybe,
Unless does anybody want to have a discussion regarding Pantheon now? Anybody have any?
yeah, Frank, I was just going to try to show Rich what's in the back of our reporting specifically for the 2014 fund. And
It's
So-
page
so-
232.
Can you blow it up a little, Britt?
yeah, I'll do my best. So this is essentially the history of Norwalk's commitment to US Select 2014. The initial commitment was 15 million. So in this second column here, capital contributions, you can see about 10.3 million has been called. So they can still call about 4.7 million. And given Jeff's comments on a lot of these investments are still in investor stage, it's probably expected that some capital will be called in the coming years. The market value is about 19 million on 10.3 million invested capital. So from the looks of it, this fund is promising. I think some of the 2000 vintage and some of the 2006 vintages clearly were not great performers. And I think, that's led to some of this board kind of shying away from these kind of investments. But this particular fund does appear to be doing well. There's still a pretty long run left in it. As you can tell, a 2000 vintage fund is still winding down, which is borderline absurd at this point. But the capital has been committed here, and this will really drive performance in your private equity portfolio.
Check back
But
in 10 years.
Yeah, the life cycle of this is, particularly the 2000, like 2x what I thought it would be, a private equity fund would be. I would think 7 to 10 years, maybe 10.
I think that would be typical. 8 to 10, 8 to 12 years is typical when you get into a market environment like the GFC or the .com, where these funds are trying to invest in a big recession. All of them, no matter who you're invested in, have extended these timeframes to points where it's crazy.
Yeah, and we had 2008 in the middle of that, so.
This was before Callan was with us, but the presentation we had was that they anticipated 7 years. Pantheon. I remember that. And I remember also Joe wasn't big on
I think I voted no.
private equity. Yeah, I know, I voted no also. Anyways, Britt, you want to go? Is there any? To me, one of the things, Chris, it doesn't matter. I don't know that we're going to have we're not proposing to put any more money in private equity. I don't believe. Does anybody have an opinion on that they would want to do that? And if not, really, there's not much to discuss. We will take a haircut, though, it looks like. 18%, I figured out it'd be like $500,000.
I'd rather give the money to Rich's manager there, that international guy.
Right. And by the way, the other thing is we're gonna really get up.
How are they doing?
we're not gonna get off to a great start because I guess everybody knows that Zeisinger is finally like,
30,
if you notice, it's like
34%. Okay.
it's zero, so at least we're gonna, there's good news and bad news. The good news is we're cleaning some things up. The bad news is, well, we're taking a hit, but I was hoping they'd do it last year because we had a big year, but that's the way it goes.
Mr. Market's bailing us out, Frank. The S&P's bailing us out.
I know.
Silchester will bail us out.
Yeah. Yeah, it's those bonds that are dragging us down. Whoever that was who talked about bonds. Anyways, why don't we get Britt to talk?
Go ahead, Britt.
Hear Frank talk about bonds for the rest of the evening. So we have, I wanted to touch on the June 30th executive summary quickly because that was the end of the fiscal year and the pension plan did extremely well. And then we can dive into the flash report as well. Just going to share my screen. Just a brief context, given that it's September, and this is really 6/30 numbers, but coming off the low of March of last year, the bounce back has been really eye-popping. You can see the S&P up over 40%, and in particular, small caps up over 60%. And this market has rotated from the growth mega cap stocks back into the small cap value stocks and really doesn't seem to know what it wants to do, but returns have been extremely good across the board in all risk assets. Given the interest rate environment, you can see fixed income, to Frank's point, has been muted, which is expected, but there is a purpose for the fixed income allocation in the portfolio. But so very strong returns for the quarter, and just going to dive in to give you some context here. Here's the just the asset distribution. Assets over 532 million at the end of June. You can see another strong quarter, 23 million of investment gains. And then, so here's really a summary of the fiscal year. Total plan returned 27.8%.
Is this OPEB or is this the pension?
This is the pension.
Okay.
So 27.8% for the fiscal year, outperforming the benchmark by 230 basis points, or even more than that, actually. So extremely strong performance. PIMCO has done really well. Their risk asset exposure has really helped them. Columbus Circle has done extremely well. They're up 20% over their benchmark. LSV underperformed. They have bounced back, as you'll see in the flash report, and have done well over the last year, which is encouraging. Your fixed income managers have outperformed. And to Frank's point, an underweight to fixed income has helped with this equity tailwind. Some things that hurt the portfolio. It's hard to believe anything hurt with a 27.8% return, but Artisan really had a pretty terrible last year. Again, I think we've lamented on it. They presented in April. They're more valuation sensitive growth, sustainable growth platform has really not worked in this volatile market environment, as the growthier names have really outperformed. And then on a relative basis, UBS, which is your absolute manager, has still performed well, but hasn't kept up with their benchmark. So overall, pretty incredible fiscal year, and just wanted to compliment the board on a great job, and let's hope for another year half as good in the next fiscal year.
As long as you don't blame us when the market goes down.
That's when I'll be talking about fixed income. So any questions on the executive summary? If not, I'm happy to turn to the July flash report to get you some more updated information.
Do it.
Great. Everybody see my screen okay?
We're still on to some, yep.
All right, so
Hey, Britt, we're still on the summary, ended June 30th.
Sorry. You'd think I would figure out the virtual world by now, but
You're not alone.
all right. Can everybody see that now?
Blow it up a little if you could. Perfect.
Yeah, looks-
Okay, great. So as of July 31st, another strong month. You can see 541.6 million total assets. Some of the rebalancing the board voted on in June took place during the month, and the contributions from the city were invested. So you can see about 10 million went into fixed income. The redemption from Blackstone of 7.5 million came out, and 7 million was invested in the Russell 1000 Index Fund. Everything's pretty close to target. You can see equity, given the strong returns, up 33.8%, getting closer to its 35% target. International equity is very close, and the redemption for global equity long short brought that back down into a reasonable position. Fixed income slightly underweight as expected. And I just wanted to highlight PIMCO still overweight at 8.5%, but within the range. And there's not much cash left. I know Chitsime sent me a note about raising some cash for benefit payments. I think she said 5 million, but I'll defer to Chitsime on that. And if that's the case, we would recommend redeeming from PIMCO. It's a small redemption and the fund's overweight pretty significantly, but happy to answer any questions or defer to Chitsime on any cash that needs to be raised.
Yeah, we went through the summer with all the whatever cash we had left from the contribution and redemption from Blackstone. So we're at a position where our cash is only about 1.9 million. So we'll need to raise at least 5 million to get me through September and October for pension benefit payments.
What's your need for the rest of the year?
Well, the pension payments is about 3 million a month. That's the norm that I've been seeing the trend. And our normal employee monthly contribution, it's about 300,000. So the net of it would be 2.7. So I guess for the rest of the year, if, just to have a little cushion, I would say, how many months do we have here? September. So maybe 10 to 12 million.
Do we want to do, 2.5 million a month over the rest of the year? Do you think that that's something we should do, Britt, instead of timing it, or?
Yeah, if it's going to be 10 to 12 million, we would say don't redeem it all now. We understand if for staff and the board's reasoning on wanting to hold the cash, that's perfectly acceptable. I mean, I would think 5 to 7 million now would be reasonable to give Chitsime what she needs to pay benefits through October, and then we can revisit it in November if necessary.
Okay.
If we brought PIMCO down to 40, what percent would that be? Anybody good at math right now?
PIMCO down to 40.
Yeah. What percent would that be?
About 7.4%.
Yeah.
Given these market values.
So do we want a motion to redeem $5 million from PIMCO? You're on mute, Frank.
But we could read your lips.
Okay, good. The thing is that
And I think you said sell bonds.
not me. We just added to the bonds. But the thing was that didn't you in the June minutes, Rich, you had suggested to give Chitsame the ability to get 5 million from BlackRock. So I don't know whether we should take some money from BlackRock and from,
Well, maybe
Right.
maybe the second tranche in November, we go at BlackRock.
You're talking about the BlackRock? Which one?
the BlackRock Index Fund, is it?
Oh, the Russell
Yeah.
1000.
Yeah. The BlackRock Index Fund. I mean, I'm just throwing that out because Chitsame could have taken money from there had she needed it. So we did as a board approve money being taken out of there. So I just am, however we want to do it, but I just wanted to mention
Yeah,
that.
but we're underweight there.
That's fine. Then we'll take, is there a motion then? First of all, Chitsame, do you want 5 million now?
Yes, I will need that 5 million
Okay, so
And
Does
that'll last
anybody-
how long?
through October.
All right, I can make a motion. I move that we rescind the approval to take 5 million now from BlackRock, and that we take 5 million now from PIMCO and defer withdrawing any further until the October meeting.
is there a
Which
second
is
to that
in-
motion?
Well, I mean, that's only a month.
Yeah, I'd raise a little more.
Yeah, but she said she's gonna need money in November. I mean, if
Correct.
we do it in the November meeting, is that soon enough?
Well, I'm, I don't know what,
That's why I'm suggesting the October meeting, because if
Yeah,
she needs it in November.
yeah, you're right. You're absolutely right. But my point is more, I don't know what we gain out of deferring the decision another month. Other than market move.
Well, PIMCO makes us some money, that's what we gain.
Yeah, I mean, yeah, market move.
Yeah.
Yeah, okay. Yeah, I'll second that.
So what's,
So there's a,
restate the
there's a-
motion, please?
the motion, I believe, is to rescind the 5 million Chitsame's
Rescind the authority to take money
authority
from Blackstone.
from Blackstone and then instead take the 5 million from whatchamacallit,
PIMCO now.
PIMCO, yeah. And then
Okay.
and that's the motion. Any other discussion?
I'd be more inclined to take more money from, have more in cash myself personally. I think,
Is that market timing or is that
no,
because
that's,
we need the money?
I mean, what do we do? We're gonna take money out every month? Is that what we're gonna do? Is that the game plan that we're gonna do? We're gonna take 5 million a month out. Next meeting, we're gonna leave 5 million in for the market? Is that what we wanna do? If that's what we wanna do, that's what we wanna do.
5 million should cover the rest of September and October, right?
So we're doing 2 months now as it is.
Yeah.
And
Yeah,
I'm
she said
assuming
2.7 a month and she's got what, 1 million now, I think you said, Chitsame?
1.9 million.
She's got 1 million now. If we give her 5, she's got 6. That should easily cover September and October.
I'd be more inclined to raise enough money for the rest of the year.
Well, we could vote on this and then you could have a proposal to have another motion to take more money out,
Okay,
right? Okay,
that's fine,
so,
that's fine.
so we're gonna vote on the motion that Charlie recommended and it was seconded by Richard.
So
And,
real quick question first. So Chitsame, if you have about 1 million now, we give you another 5, you have 6.
Mhm.
Will that hold you until the November meeting?
she says
Yeah.
1,000,009. Isn't it 1 million? Am I incorrect? Or did I hear you say you have 1,000,009?
Yes, 1.9 million.
Oh,
Yeah, so
1.9
it's
million,
closer
okay.
to 2 million than 1, yeah.
So she'd have almost 7. So that'll hold you until the November meeting?
Yes, that should be fine.
Okay. Okay,
Okay, so we're gonna vote on the motion for the 5 million, and then afterwards, Joe, if you want to present another motion, that would be fine. All in favor of the motion as read by Charlie, to take $5 million?
did we have a
All in
second on it
favor?
before, did we have a second before we vote?
Yes, we
Yes,
did.
I seconded.
Richard
Okay.
seconded. All in favor?
Aye,
Aye.
Aye. Opposed? Passes unanimous. Okay, are there any other motions? Joe, do you want to propose anything?
I'm just wondering if we could just take the money out for the rest of the year, unless, because every month we're gonna be taking money out, right? I mean, that's what we're gonna be doing.
every 2 months. We don't, she doesn't need any more money until the end of November, till the November meeting.
Okay, I see where we're going with this.
I mean, one of the realities is we are reaching a point where we have to remember that, what was it, 54 people collected pensions, which means that they are no longer contributing to the pension plan, which means that the money that the contribution from the employees has gone down over time, and the payout has gone up. I think a year or so ago it was closer to 2.3 or 2.4, if I'm not mistaken, Chitsame, right?
Correct.
And so, we are at a time when this fund has a negative draw. We could be taking $30 million out a year.
I've got my retail hat on. Maybe that's the problem. Markets, we're at market highs, and we're taking money out. Maybe we should come up with a different strategy as our cash needs. Maybe we shouldn't, but if it was me, I would be looking out for more than 2 months.
Yeah, I agree. And I think I don't know whether it's the last meeting or the meeting before, I suggested that we develop a regular, we agree on a regular program of doing this. So we're not having this discussion every couple of months.
Every month.
I mean, Britt, what do you think of that?
We should have 6 months worth of cash needs in cash. That's my opinion.
So Brett, has the UBS fund ever, how often has it had a negative month? I know it's in the data somewhere, but do you know off the top of your head?
I do not. Let me see. Bear with me here.
I mean, because one way to do this would be to sort of, bring, if you think we're at a market high, Joe, to gradually move money out of equity into the absolute return fund. So we're not out of the market, but we're not in an investment that might lose money, and then take it out of the absolute return fund as we need it.
I think the only issue there is that the liquidity for UBS is not going to be like a mutual fund for PIMCO or BlackRock. So it's quarterly with 60 or 90 days notice. So it's really 5 or 6 months.
If we did that on a quarterly basis, that's one way to do it, right?
Yep.
So, you kind of load up the UBS fund, with whatever you think you need for the next 6 months or so, and then you need to give 3 months notice to pull it out. Maybe that's not worth it. It's just moving money around.
I would suggest if you're gonna do that and try to use more of a liquidity bucket to really hold future cash, I would use Prudential. It's really a conservative bond fund that is very liquid, and you can raise cash from there in most environments. I think UBS, there's a lot under the hood there that in a volatile market environment could get very complicated very fast.
Yep, that's fine. So might I suggest we have this discussion at the next meeting, and we think through what's a logical way to do this, and kind of look ahead 3 to 6 months, for Joe's. I think it's a good idea.
Well, why don't we, Joe, would you like to, it sounds like Rich would be in favor of what you're suggesting.
I'm gonna be real simple. I
Right,
make a,
well-
motion I make a motion, we take $5 million out of the Russell BlackRock 1000 to put it in cash and get us through the end of December. We're halfway through September.
Does anybody want to second that motion?
Yeah, I'd second that. I'm okay with that. But
Okay.
we are under allocation targets on US equities. That's the only issue with that.
Yeah,
we-
but that's the biggest
remember,
bucket.
Our allocation, we have a broad band,
Yeah,
so we're within the band easily, so that's not a
yeah,
problem.
I'm okay with it. Yeah.
Anybody,
I would
Rich?
agree with that too.
okay, so there's a motion and it's been seconded. All in favor?
All right,
Aye. Opposed? Nope, passes unanimous.
there you go.
Take 5 million. So we're
Okay.
gonna have, Chitsame, you're gonna have a total of $10 million,
Great, thank you.
okay?
And can we, is this something you would do? Is Britt present us with with a withdrawal schedule that is fits with with the pension, with our situation here? I mean, is
Sure.
that something you do?
Yeah, absolutely. I think, one thing that the board could do is make a motion every 6 months to give Chitsame the authority to raise the cash, so you do not have to discuss it. And most of our clients will defer to staff for cash needs. So what we can do is bring back a scenario or two that our clients employ that allows benefit payments to be made, cash to be raised from places that are liquid and reasonable without burdening the board with discussing raising cash each month. So it might be once a quarter or twice a year, depending on what your comfort level is, but we can bring some options and some client experiences on how they do this.
Yeah, I would really appreciate that.
Yeah.
Sure.
I think
We'll
that's a
find
good idea, but one concern would be that if we should, I think, diversify some of the withdrawals, and that we don't want to just continually take our most liquid assets, and then later on, we end up with an imbalance that we have a lot more illiquid. So that if we're going to do a plan, perhaps we could go out and say that if there's a call that requires 90 days, that we take some money out of that fund.
That's fair.
Yeah,
So-
I think, Frank, typically clients, whatever is farthest or most overweight in the liquid markets would be where they would draw cash from initially. So that's really a starting point. But we can bring some different scenarios and some different experiences and try to find something that fits something for Norwalk that might work going forward.
Right, because I think that, again, I mean, one of the things with say the private equity, this is why I remember Joe and I not being in favor of it. It just didn't prove to be what we thought it was going to be, and the liquidity is not there. So that maybe there are some other funds that if there's a period of time that we have to give redemption notice, we give it to some of them. Any other discussion? Did you want to go over anything else?
Yeah, I just wanted to touch on performance and highlight. I had a call with Columbus Circle a few weeks ago to get a business update. If you remember, Cliff Fox, who was the lead PM, retired. And performance has been exceptional. You can see here, the last 12 months, last 3 years, I mean, across the board, it's been really good. But a lot of their clients terminated them when Cliff Fox retired, to the point where total assets at the firm are about $2 billion, which is down from about 5.5, 4 years ago, and their peak was closer to 15. They do have a parent that owns them, Principal, and they're a boutique under them. So we do have confidence in Principal using their resources to help grow assets within Columbus Circle. But we wanted to bring it to your attention because it's a little alarming with what's left, in particular in the SMID fund that Norwalk's in. So Norwalk's balance is about 24 million. Total fund assets are about 725 million. And there's only 6 clients in the SMID growth fund at Columbus Circle. And the top 2 clients make up 85% of the fund. So we don't think.
Have the top clients redeemed elsewhere?
So I can tell you that every other Cowan client redeemed from Columbus Circle when Cliff Fox retired.
Wow.
Their existing clients, I don't think intend to redeem on any immediate scale. And we'll certainly continue to watch it because it is something to be aware of and could be a problem if one of those large clients leaves.
Hey, Britt, well, we had them in, how long ago were they in?
I think they were in the beginning of last year or beginning of this year, I think. I can check if you give me a sec here.
This guy, he's retiring, is that the story?
He retired.
So he already retired. He retired at the end of last year.
Okay.
And, I think a lot of clients were worried about the key person risk and really clearly didn't have faith in the process and the remaining team under Cliff. I don't think Tom or myself felt that way. And I think the performance has proven that. It's not a team issue at this point for us. It's really just an assets under management and a viability issue.
What would the drop in assets? So the assets are down 50%, right? Roughly.
Yeah, total firm assets down 50%. I mean, the SMID fund at its peak the last few years was only at 1.1 billion. So maybe call it 300-400 million of left, but there's still certainly substantial assets there. I think what gives us comfort is that, a firm like Principal that owns Columbus Circle is a huge firm with marketing resources, operational resources, and Columbus Circle just fully transitioned to utilizing all those back office resources at the beginning of the year. They are marketing. I mean, they have a track record here that speaks for itself in performance. So we have faith that they can grow the assets, but we're certainly going to have to continue to monitor them pretty closely given the reduction.
What if anything does that reduction in assets do to the compensation of the remaining portfolio managers?
So we asked that question. They said their performance is really, or their salary is really performance based. So I don't think there have been a lot of changes there, if any. It's still a boutique. They don't have a lot of investment people. The team isn't huge by any means. So they're really, the key people of the team have been there. They still are there. They have no intention of leaving, and they're quite young. Chris Corbett, who you've met, is the new lead PM, and he's in his maybe early 50s. We have confidence in him, so I don't think anything's changed from necessarily a pay scale. It's more of Principal's profitability on this firm has gone down, and they really need Principal's support to grow assets and really get this firm back to where it was. So,
if they're actively raising, they're actively out marketing?
They are now, yes. So I think
can we get some kind of a feel in November of how successful they've been, or do you think the sales process is going to be until January that we see how successful they're being raising more money?
Yeah, I think we have to give it another 6 months to a year to see if there's any traction. I mean, just speaking for the institutional world, you know, a departure like Cliff Fox would probably mean this firm and team doesn't even get included in most searches for a SMID cap growth, simply because people want to see how the new team is doing for a longer period of time to make sure that it wasn't Cliff Fox driving all this performance, and it really was the team left and the strategy that they employ. So I think continuing to monitor it, revisit, have them back probably early next year or later this year, maybe in December, to provide an update on all of that is probably the prudent thing to do.
What, can I speak for a moment? Because this is like, it has got some relevance that Zeisinger, I think that when that fund, I think the only one, I don't know whether you're on the board then when Zeisinger retired, Joe, but Charlie was.
Yes.
And remember that, Charlie? And we ended up, and before that, Zeisinger was an incredible performer. It was our cash cow.
It was really just him.
It was our cash cow, right?
Yeah, I mean, we made a fortune with him, but it was really just him, not a team, not a firm, just him.
Right. And one of the things was that after, in fact, I was surprised because when we decided to take money away from him, Charlie was all in favor of that because of that. And then as we took money out, the fund at one point, the vast majority of it, like 65 or 70% of it was, I remember this, the Idaho Teachers Fund or whatever. And that was a problem. And I do think that having money in a fund where one, you know, if I'm correct, you said that two of the largest holders in the fund are about 85%. If one of them decided to leave, I mean, these are like small stocks. This, you know, I think that we should really consider, you know, maybe thinking that Fox left. He was the brains of the operation, just like Zeisinger was. I could be incorrect, but
If Frank, to draw a parallel on what you're saying is Zeisinger, if I'm not mistaken, his forte, his specialty was almost micro cap stocks. Out of Columbus Circle, out of their holdings, the concern would be if a big investor leaves or redeems, will that affect us? In other words, in the Russell 3000 or 1000, if money goes in and out of that, doesn't affect us. Is the holdings that Columbus Circle in that SMID space, are there any holdings, I can't answer, are there any holdings that are not as liquid? And if a big investor leaves, it's going to affect us.
Yeah, Joe, that is not the concern here. And all Columbus Circle does is small and mid cap stocks. So that's all they do.
Okay.
And I think the concern is if the two largest investors leave the SMID growth fund and assets go down to, call it 100 million. It's no longer profitable, most likely. And unless principal continues to support them, they could potentially shut the fund down.
Well, I'm concerned about our holdings. If a big guy leaves, but you don't think that's an issue, Britt, is what you're saying.
We have faith in the remaining team. We think, the lead PM, Chris Corbett, and Mark Shapiro, his co-PM, they've been at Columbus Circle working with Cliff Fox for 20 years.
And the holdings that they have are liquid.
Correct.
Right.
Well, and I think the key is, are they a significant investor in any of the holdings? Because if they're holding, less than, a few percent of the capital value of the market cap of any stock, you know, I think you're worried, Joe, are they gonna have to sell, are they gonna have to sell their stock, their shares under pressure to redeem?
Would that hurt us?
And would that hurt us? And that goes more to what percent of the companies that they're invested in do they hold? If it's low single digits, it probably doesn't matter.
That's a good
Yeah,
point.
I think it's not, the numbers that Columbus Circle is investing is not an issue. It is,
Okay.
there's not
Okay.
large enough
Okay.
to have any illiquid problems.
Don't you think that trying to sell, you know, I mean, the Russell is a pretty volatile index. I mean, today was, with the Dow down, 20 bips, the Russell was down 1.15, and it does have a lot of volatility. We don't know whether we don't know whether they hold positions that are equal to like a day's volume or 5 days volume. Those, I just think that we should at least consider that past history was, if we would have been better off getting out of everything right away out of Zeisinger. And
The question is, how much was, what share of what percent of the shares did Zeisinger own in some of these companies? If they're micro caps, he might have been 20-30%.
I think Joe was incorrect on that, because if you look at their old portfolio, it even included stocks like General Electric. That certainly was not a micro cap.
Okay.
And from a profitability perspective, I mean, Principal owning them and backing them is a huge plus in our opinion. I think if Columbus Circle was on its own, like Zeisinger was, we would recommend termination immediately. Because they're backed by a large investment manager that owns a number of boutiques like Columbus Circle, they have the resources, assuming they're deployed correctly, and Columbus Circle continues to perform. I mean, they haven't had any hiccups since Cliff's retirement. They've done extremely well. We see no reason why they can't grow the assets. It gives a little comfort to us that Principal is their parent and is backing them, and they're not just an individually owned firm.
Correct me if I'm wrong, but aren't they the one where their investment process basically entailed all the team members kind of voting anonymously on picks?
That's Silchester.
Oh, Silchester, okay.
Yep.
But Columbus Circle, because I asked some guys who I know on the street about it, and they're real momentum players, right? Momentum up, momentum down.
Yep.
How much money do we have there, Brett?
About 25 million.
25, okay.
And maybe, I mean, I would suggest that we have them in again, so that everyone can ask these questions directly to them, to try and get a comfort level if there is concern. That would be my suggestion. I think, we've watched this and knew it was coming to a degree, but it was a little more alarming when we got the numbers a few weeks ago. And, I don't think we're worried about the viability of the firm, but it is enough to give us pause and continue to really closely monitor both flows and performance.
When did these withdrawals take place? Is it over the past 6-9 months, or is it just recent?
Yeah, year to date. So basically since Cliff's retirement.
Okay.
I think one of the difficulties too is when you have redemptions like that, usually you could sell what's most liquid, and so you can end up with the stocks that have thinner markets and are more volatile in the portfolio.
These are the SMID cap market is large, and the amount that they're trading is really not going to be affected by any illiquidity.
I thought you said they were small and big cap.
Small and mid cap, but I mean, we're talking the volume of these stocks being traded in that market is high, very high, and the amount of money that Columbus Circle is trading is very low.
Their trades aren't moving the market, in other words.
Yeah, I'm looking at their fact sheet for the end of June. They have a maximum position size of 5%. Their weighted average market cap is 10.5 billion versus 7.3 billion in the benchmark. And the median market cap is 8.2 billion versus median in the benchmark 1.9.
How many
So-
holdings? How many holdings, Rich?
They have typically hold 60 to 90 issues, and their top 10 are 25 to 35%. So, you know, they're
Okay.
They're well diversified and they're not moving, and they're not
Right,
moving the
having-
market.
yeah, working, you know, I've been working with some other SMID growth portfolios, and the yeah, they're the mid of the SMID is doing pretty well. Looks like they're tilting themselves to there, and so
Okay.
you know, they're 27% healthcare, 20% information technology, 10% industrials.
Well,
Means
it wouldn't
so,
hurt to have them back in. It wouldn't hurt to have them back in.
Yeah. Yeah, I think
about-
I'm fine sticking with them for a while, but let's have them in the next 2-3
Yeah.
months.
Yeah, how about having them in November? Would that be reasonable?
Sure.
Thanks for bringing that to our attention, Brett.
Right.
yeah.
Of course.
Any other business? And if not, is there a motion for adjournment?
Motion to adjourn.
Is
Okay,
there, all in favor?
Aye.
Aye. Opposed? Nope. Excellent. Next, OPEB. I'd like to call the meeting to order of the OPEB, other post-employment benefit fund. Is there approval of the minutes? I read them
Making a motion.
over. I thought they're fine.
I'll make a
Is
motion to approve.
Second,
Is there a second?
second,
All in favor?
Aye.
Aye. Opposed? Nope. Passes unanimous. Are there any public comments? There's no one in the public before. I doubt there's anyone now.
No, no one.
Thank you. And then performance review. Go to it, Britt.
Great, I'll be quick. Again, just wanted to bear with me here. Just wanted to highlight fiscal year performance again. My computer will stop freezing. There we go. So at the end of the fiscal year for the OPEB, you can see the targets versus actual, pretty close, little overweight to domestic equity, underweight to fixed income. Total assets, about 134.5 million. And performance here, you know, a little more exposure to equities. And you can see the last year, which represents the fiscal year, extremely good returns, up 31.5%, about 400 basis points above the benchmark. And you can see equity returns were exceptional. Your fixed income managers outperformed the lowly index, and PIMCO had a great year. So again, exceptional performance for the fiscal year for OPEB. And I'm just going to quickly touch on July flash report. That didn't work. Sorry. Try this again. Can everybody see this?
Yep.
Yep.
Right. So here at 138.2 million, the OPEB, you can see 2.8 million invested in the MetWest Core Plus Fund. That was from the June meeting, which brings everything in at target very close. You can see almost no diversion here from the actual weights versus target. And here we show performance, and for the month, up about 63 basis points. PIMCO trailed the TIPS index, but longer term, very strong returns, all outperforming the benchmark. Happy to answer any questions on the OPEB.
Yeah, I have one question. So this like last 12 months, is that right? Is this a typo? Fixed income was down 0.02 and domestic equities were up 38.96.
I need to buy you a beer, Frank.
Oh, God.
Okay,
No, yeah, that is correct.
I know I'm gonna eat these words one of these days, don't worry.
Ride it while you can, Frank.
I know.
We'll
Frank,
remember.
if that's our biggest problem, we'll be happy to continue to take the remarks every meeting.
Any discussion? We got the money from the city, right, 2.8 million, and if no more discussion, is there a motion for adjournment?
Move to
To
adjourn.
adjourn.
The second,
Again,
all in favor?
aye.
Aye.
Aye. Opposed? No. Passes unanimous.
7:30, good job.
Good
Hey,
job,
we gotta
Frank.
do it. Hey, Britt, one thing is, we don't know about, I think I got an email from you, but you will be remote through the end of the year?
Through October for now. We haven't received any update past that. So we'll see. I think just see where things go.
Okay,
We're happy to attend when we can. Just want to make sure it's safe for everybody.
right.